Welcome everyone to the Wyckoff Analytics Wyckoff Trading course, part 1. My name is Bogomazov. I will be your teacher, instructor for today and for the next 15 sessions in this course. We have two groups of people. We have students who already signed up for this course, so welcome. Looking forward to working with you this fall semester. And also we have people who are guests because today is an open door session as usual. You are welcome to check out our offering, ask questions, stick around, go through some of the chart reading exercises with us together, and then decide whether this is the course for you or not. And if you have any questions, please feel free to email us. Go to our website, wyckoffanalytics.com, email us at wyckofassociates@gmail.com, info@wyckoffanalytics.com. And I'm looking forward to working with you as well if you decide to join us. As usual, everything that we discuss in these classes is for educational purposes only, so please keep this in mind. All right, some of you came here because of the raffle that we have had this week, and this is the first time that we do that. Look at that hat. This is our Wyckoff Analytics hat. We also have t-shirts. We're going to be doing the raffle, I think, every month now. At least that's what our team is planning on doing. So we've conducted the raffle, which was the anonymous randomized raffle if your name is in our weekly newsletter. And we have a winner. It's Ying C, and this month's prize from us is the Trader's Cap. So congratulations, Ying. Nancy will contact you for your details and we'll send you the hat. And for those who are interested in our monthly raffle, well, then sign up for the newsletter. Be a part of our community. And this is something that we give out to our traders, our community members on a regular basis. We have quite a lot of different games that we play, and as a prize for those games you receive either a t-shirt or a cap or something else. To be a part of our community, again, I mentioned the weekly newsletter. It's completely free. Usually you receive a lot of market update through the newsletter, any type of offerings that are upcoming for the semester, any type of announcements from us, any type of raffle that we're going to have. So sign up for that. Our YouTube channel, we have over 1,000 videos. You could literally educate yourself on Wyckoff methodology just watching that. But if you want to be having an on-hands experience together with me, together with other people, together with other students, being in the class and asking questions, doing the homeworks, doing this work, doing a lot of practice exercises, well, then come to the classes. You could follow us on Twitter, our handle @Wyckoff Analysis, and we're pretty active there. Each day we're posting quite a few of those posts on market analysis or any type of videos from our classes of the day. So I'd say this is probably, together with YouTube, are the best two social media sites to follow us. Also, for those of you who are into crypto trading, we have a crypto Discord, which is being led by one of our team member, Alessio, and he is trading cryptos. He is creating a lot of, indicators for his crypto trading. I would absolutely sign up and at least check it out. So today, we are starting our new semester. For those of you who are still thinking about this, bear in mind that our semester starts today. But because today is an open door session, we're going to talk about the benefits of joining the class. And I'm going to give you some of the material through the trades that I've done, or our trainees done, or our students have done. And we'll talk about the Wyckoff method through those trades. If you decide to sign up, go to our website, find the WTC course part 1, sign up, or if you have any questions, contact Nancy at info@wyckoffanalytics.com. She will be glad to receive any emails from you, and she will answer any of the questions. For those of you who are returning students, WTC 1 alumni, your rate is less, so please keep this in mind. And also, I want to point your attention to the payment plans that we have. It's a zero interest for recurring payments that you would have to go through, and pretty popular option among our students, and very, very doable. Here are the class details. It's 2.5 hours for each class. This is Pacific time. I'm on the West Coast in the US. So we start at 3 p.m. Pacific, 2.5 hours, 15 sessions. And on the top of all of that, of all of those hours, which you don't have to be necessarily in the class, in live class, you could receive all of the videos on demand after each session. By the night time, you will have the video, you will have all of the slides from the class, you will have the slides for the homework. For those of you who are students, I want to mention one thing, but we'll talk more about this next time. Your homework for next week is going to be just reading. But when we start working with charts, I would like to receive one file per homework in this formats: PowerPoint, PDF, Word doc. I want you to also, send us an email with the title that is specific, with your first name and your last name initial, telling us what class you're in and what homework that is. Send it to either wyckoff@gmail.com or use our other emails to send your homework. And I do go through all of the homeworks. It's not necessarily that I will be commenting and emailing you back, but we will go in the class through the commonality of the mistakes. I will use some of your slides, to point out certain things, and we will be, digging into the concepts that way. So with that, homeworks are an integral part of this course and extremely beneficial for our students. Is this session being recorded? Absolutely. And as usual, because this is an open door session, we will be posting it on all of our social media platforms, including the full session on YouTube and some smaller video clips on Twitter. So stay tuned. If you can't attend the whole session tonight, you could just find this session later on our YouTube channel. And as always, all of our recordings and slides will be available for the paid students, and the instruction on how to access those will be emailed you, and I'll talk about this later on. All right, I also want to mention that tomorrow we have another complimentary class at the same 3 p.m. Pacific, and this is WTC2, Wyckoff Trading Course Part 2. So this is what I call a practicum. If WTC1 is all about the knowledge, then WTC2 part 2 class, the practicum, is all about practice. And it's a deliberate practice. This is where we play a lot of the bias games, where I put the chart in front of you and you have to analyze the chart and figure out the bias, whether it's an accumulation or a distribution, and then we go through your analysis and we go through a lot of feedback. And we also do in each class an action sequence exercise. This semester, I'm going to have a teacher assistant helping me out, a brilliant chart reader, Antal. He is one of our trainees, and just he's extremely good at reading the chart and seeing the truth of the chart for what it is. So I'm pretty excited. A lot of our students are taking this class multiple times because to build the habit of reading the chart correctly takes time. I mean, like, it takes literally a lot of time, a lot of repetition. So I usually would say that it takes about a year and a half to absorb all of the material that we give you and to build up the skill to the level that could materialize into profitable, consistent behavior in the market. And it's still not going to be, perfect, but at least we see from our students, or majority of them, that this is where a big shift happens. All right, let's go into some questions. What is the Wyckoff method? And by the way, please feel free to also ask any other questions at the end of the session. I'll ask you if you have any questions, I'll be answering those, so stick around if you have one. And then along the way, we're going to be doing some exercises. I want you to be active. As usual, our classes are extremely interactive. So with that, feel free to write down any questions, any answers. And let's start with this question. What is the Wyckoff method? Wyckoff method is just one of the technical analysis methodologies that is based on identification of the dominant force, either supply or demand, selling or buying, and its effect on the price. Also, the idea of institutional activity behind all of the trends is extremely important to the method. So we'll talk a lot about the composite operator as the heuristic for institutional behavior. I will show you a lot of the ways of how to identify the presence of institutional buying and selling on the chart, and that's going to become a cornerstone of the conceptual Wyckoff methodology trading. Does Wyckoff method work? Absolutely. Wyckoff method worked over 100 years ago when Wyckoff, codified it for us. There is a lot of, similarities in the construct of the methodology with other technical analysis methods. But we love Wyckoff method for the depth and the detail of it. We've definitely taken many steps forward from the original course, from the course from SMI, from the course that we had at Golden Gate University. And what I'm going to present to you in WTC1 is an updated version of all of the knowledge that has been collected for more than 100 years ago. And you could trade and analyze your charts using the Wyckoff method in different markets, whether it's cryptos, futures, forex, equity, or different time frames. And the only obstacle that I see from all of these years, and I've been doing this for almost 30 years now, is just the ability of the trader to practice countless hours, developing the skill, developing the proficiency. Because it's only then that you could see actual results. And, I see this from many students. I mean, I've taught thousands of students, and it's not enough to just be present in the class. You really have to engage yourself in the practice, in the drills that we have, or do it yourself, and only then you will start improving. What is the curriculum for WTC1? 15 sessions, as I mentioned, and we're going to start with the market structural analysis. So what does that encompass? We're going to talk about structure a lot. We're going to talk about price structural environments, different environments. We're going to talk about the changes of character, changes of behavior. Wyckoff methodology is famous for its events and phases. Right, so you probably all have seen schematics, Wyckoff schematics, the ones that I've posted on the stock charts years ago. Those are extremely popular, and we'll talk about, what is it that with the schematics that we need to see. Schematics to me is more of the guideline. They are not necessarily something that we need to follow to the last letter, but it's something that we need to understand conceptually. And WTC1 will fully cover that. In sessions 6 to 10, we're going to talk a lot about supply and demand. And this is probably one of my favorite topics, just in general, in technical analysis or chart reading. We'll talk about volume and price analysis, how effort versus result could be seen on the chart. And we're going to concentrate on the bar by bar, swing by swing analysis, and also historical analogs. And then for a couple of sessions, we'll talk about the relative and comparative analysis. This is relatively, similar to everything what institutional people are doing. So that's why we want to know how they think and how we make that selection. Now, sometimes when students say that they base their selection on the relative and comparative analysis, I beg to differ a little bit. I think that selection analysis extends beyond that, and it actually goes into supply and demand as well. Because there are, as I always say, a lot of opportunities in the market. There are fewer opportunities that you can recognize. There are fewer opportunities that you recognize and that are gonna outperform, and there are even fewer opportunities out of that that you could recognize they will outperform the market, and at the same time, you know, the ones that you could actually execute at a very high level. So we are going to show you the way how we look at the relative and comparative analysis. I'm going to introduce you some of the proprietary stuff that we've developed, and we'll talk a lot about filtering and scanning. And the idea here is just to identify the best out of the best opportunities for the market environment that we are currently in, and then uses the least amount of time to come up with those ideas. And then in the next two sessions, we'll talk about the trade management, your points of entry, your stop loss, how do we move the stop loss, your trims, your add-ons, your exits, sizing, portfolio sizing, and so on and so forth. But more on that will be done in WTC2 class. And I would say that the trade management, once you start reading the chart correctly, becomes extremely easy affair, because once you understand the rules of engagement and you see how the chart develops, then it's way easier just to trade just in general. Session number 15 is usually devoted to the Q&A for the whole semester. So this is just a collection of like a bunch of questions, and we spend like a couple of hours going through many questions. That doesn't mean that you cannot ask me the question during the class. If you're in a live class, yeah, shoot away, ask me a question, write down the comment. Again, our interactions with students is pretty high. All right, so what are we going to do today and in session number 2? Today is an introduction session. Your homework is going to be Jim Forte's Anatomy of a Trade article. For the students who already signed up, you could find this article on your page for the class. Please read it. I'll show you more on that a little bit later. We're going to do a quick market update. This is a very usual occurrence for us in each of the classes. I'm trying to quickly go through all of the major charts and just to point certain things that I see. We're going to do this again today. And then we're going to go into a couple of exercises, but I'm going to be showing you some of the trades, actual trades that either I have made or our trainees, our students have done. And we're going to look at those trades from different perspectives. We're going to look at the intraday trade, we're going to look at the swing trade, we're going to look at the long-term swing trade, and we're going to look at the campaign trade. As we go through those trades, I'm going to be giving you a lot of pointers on how to read the chart correctly. And I think that's going to be the biggest benefit from this session alone. So if you're here just for this session, stick around, go through those charts, and as I'm asking you questions, participate, you know, write down your answers, or at least, you know, have a conversation in your mind with me about how you read the chart. And a couple of those are going to be the exercises. And then we're going to have a little bit of time for the Q&A. And then in session number 2, we're going to start diving into the material. We'll talk about really briefly about R.D. Wyckoff himself. We'll talk about the composite operators, the heuristic for us. We'll talk about the price cycle model as something that every trader needs to understand, how the price behaves, how the behavior of institutions driving the price through different price cycles. And then we'll talk about the behavioral market analysis. Who are the participants, what their intentions are, how do they behave in the market, and how that translates onto the chart. How do we see strong hands and weak hands? And then we're going to go into the details of accumulation and the change of character, change of behavior. You will have the homework number 2 on the accumulation labeling, and this is where I'm going to give you the charts, and I will ask you to label them with Wyckoff terminology. We will review that in the class after that, and that's going to be our second class. All right, so go sign up for WTC Part 1 class. If you have any questions, contact Nancy at info@wyckoffanalytics.com. Here's this article by Jim Forte. Unfortunately, Jim Forte is no longer with us. He was a friend, he was a colleague, he was a part of our local community at Golden Gate University. A brilliant man, brilliant analyst. Unfortunately, passed away too early. But his article that he wrote for the MTA Journal in 1994. And MTA now is the CMT. If you don't know that organization, Chartered Market Technician Organization. Anatomy of a Trading Range is the best article on price structural analysis that I've read. There were a lot of attempts to recreate this article in their own way. They all worth reading, but for my students, I always refer to this article. If you have not seen it, you don't have to even Google it. Go to our website under the free resources. You could find this article and you could download it from our website. For all of the students who signed up or will sign up today or tomorrow, please read this article. Read it slowly and read it thoughtfully. And I want you to make notes. And if you have any questions, we could discuss them in the next class. All right, let's do the market update. So what do you guys think about the S&P? If I were to ask you, what is the trend for of the market? What would you say? Write it down really quickly. Do you think that we are in the uptrend, in a downtrend, or in the trading range? Those are the three major price market environments that we would be discussing. How do you see it? All right, uptrend, long-term uptrend. Okay, trading range, uptrend, trading range, uptrend, trading range. I like that some of you starting to differentiate the time frame. So for those of you who are stating a long-term uptrend, so what does it mean? It means that since 2009 secular low, we are most definitely in the uptrend. If we were to take a more immediate trend, let's say since the lows in October of 22 or any of the lows in 23, we are also in the uptrend. And short term, I would be thinking two ways here. We are definitely seeing a change of behavior reaction. This is the reaction that is pretty aggressive. It's not necessarily larger than the reaction that we had here, but it definitely contains an increase of the supply. So in itself, change of behavior is an invitation for us to consolidate, to test the supply that has come. And with that, I could say that on a short-term basis, we are in the trading range. That's idea number one. And secondly, if you're going to go to the swing short-term, let's say short-term structure, trading range, short-term swing is going to be to the upside, at least at this point. We have not had the reversal yet. There are quite a few possibilities here that I could see. If we are in the trading range, then I'm kind of questioning the strength of this rally. Look how much volume is required to travel like this. Oh, wow, this is pretty aggressive, right? Look at how supply is increasing, and we see a lot of hidden demand in this area. What does this hidden demand behind this volume spike produces? Pretty aggressive move to the upside with the bars like this, this, this. And what's in between those bars? How much of the supply is coming in between those bars? There is nothing there. So with that, even though it looks, and I've had a lot of comments from different people, students telling me, well, how could the price move like this aggressively and yet the volume is decreasing? Well, look into this area right here. Same story. Supply was increasing. We see that on the way down, we have a lot of hidden demand that is increasing. And look how the price travels here. The same way. We could make some kind of analog of this initial takeoff bar to the upside when we have a combination of these three, and look how supply is reacting in this area. And I would be expecting something similar as what we've had here to hit the resistance and then to have some kind of reaction. And this is what our suggestion was as a point of analysis last week and a couple of weeks before. After the initial takeoff like this, the expectation was that we're not going to consolidate in the lower part of the trading range, but we're actually going to reach the upper part of the trading range, stop, then have some kind of reaction, and probably continue to the upside. So that's our working hypothesis. But at the same time, we could also be thinking that we could have different reactions, different trading range, before we are breaking out, and the shape and the form of it will be dictated by how much supply is coming in. So far, I do not see a lot of supply coming in. It only is an exhaustion of demand that is going to dictate of how much of the reaction we're going to have. All right, let's go somewhere else. Let's go to, and I usually go through NASDAQ. I'm not going to do this today, through Russell and the Dow. Not going to do it today either. Let's go to a 10-year because this story of the Fed and the interest rates is extremely important to us on the multiple levels. We've been absolutely spot on the 10-year, and we were talking about this area right here of how aggressive the price always comes down. Once it goes up, aggressively going down. Once it goes up, aggressively going down. Again, and then again. So our expectation was that we're gonna make a lower low. We're gonna come to this area and we're gonna start accelerating. The fact that we are accelerating into the lower part suggests that the selling is actually aggressive in the lower part and suggests that it's not off the top that they are selling, but also in the lower part of the trading range. And that suggests weakness, further weakness. Now we could consolidate here, we could test more, and we see, the retest, we see that selling is diminishing in this area. And one might ask, well, how do you see this? How do you see that selling is diminishing? You don't have the volume signature here. Well, we could read volume signature without even looking at it. We could just look at the spread and we could identify where volatility starts to diminish, and that's what produces some kind of moves. All right, so still favorable for the overall market. Let's go to gold. Gold is pretty interesting. I'm going to show you the trade that I've been having in gold, for a long time. Again, like our read on gold chart throughout months and months has been, spot on. We've been talking about this strength right here that suggested that we're going to overcome the long-term resistance. We've talked about this supply that came in, suggesting that we're going to have in some kind of test and trading range. We've talked about this strength right here, and a lot of our students took on those swing trades right there. This trading range we basically nailed with after this bar, which is similar and analogous to this one right here, where supply comes in and we go into the trading environment. And then all of the analogs that we've talked about, including this bar right here, was just perfect. Now, this was an interesting spot because the volatility has increased. We see the increase of the supply, and we see still higher lows here. So on the weekly, this is more visible as an absorption. And For us, coming out of it, the call was just, a continuation. Really like how gold is trading right now. Even for intraday traders, I would highly suggest that you do that. Now, Bitcoin was definitely an interesting puzzle. The key for me was this bar right here. Even though the vibration of the whole trading range has started right here, but there are quite a few analogous studies that we could, introduce here. For instance, one of them, 1, 2, and 3, the ending of this down move that leads to the next meaningful reaction. Well, look at this, 1, 2, and 3. And now we're seeing that this is weaker, the second instance, right? So it leads to a slightly better rally. It doesn't have, this type of the reactions, but the conclusion of it is the same. It's the lower high in the downslope information. And because this is lower and the spacing is increasing, we are expecting a way, way more volatile rally. We've called the character on this to increasing the momentum, increasing the velocity, and also to make a low. So it was just kind of like a perfect call there. This bar is somewhat, disturbing in itself. It looks as if everything is so great, right? So it looks like an ease of movement with such a low volume. When you consider, a volume spike like this, where there is a lot of hidden demand coming in, suggesting that there's going to be a big push. So we saw a lot of the traders being caught up in this bar, and some of their stop losses were hit at about 1/2 of this bar. But the main thing that I see in this bar is that there is no immediate follow through. And to me, this is still weakness. So therefore, I'm still pretty much, suspicious about Bitcoin. I think until we actually overcome the highs, the previous highs that we have made, we can't really talk about the strength of the Bitcoin, especially after a bar like this with no immediate follow through. We need something that is going to be way, way more dynamic, aggressive, and more importantly, committing. So therefore, I'm expecting that we're going to be somewhere here in this area, consolidating, testing, the same way how we've done before multiple times at the same level. And then a peculiar case of oil. Oh boy, oil is one of my favorite assets, just, in general. And I think that the key here is just to be on a higher time frame. And again, with students, we'll talk a lot about how do we actually set up the chart to analyze it correctly. What's the correct time frame? What's the correct structure? What are the correct lines, and so on and so forth. So I wouldn't say that we are completely out of the woods. With the two most recent declines, we were more successful swing trading this type of environment rather than long-term trading, just because the price just does not leave the trading range. In the most recent action, we definitely seen some demand is coming in. We're seeing less selling, and let's see how this week is going to develop, because the start to it is pretty good. If we could lower the volume signature and still extend, that would show some ease of movement. And obviously, we're still interacting with the long-term resistance that was originated back in 2022. Pretty interesting market. All right. So this is my quick overview of all of the markets. During the class, we're gonna spend a little bit more time on this. I usually prefer to spend between 10 to 15 minutes, maybe 20 on the markets, but this is an every class event, so you can expect my market update in each class. Speaking of the market analysis, on Wednesdays, together with Bruce Fraser, a brilliant Wyckoffan with over 50 years of experience in the market. We conduct our Wyckoff market discussion. This is where we discuss all of the markets. This is where Bruce brings his chart, which is just tremendous charts. It's not just the Wyckoff charts. He talks about the Fed, he talks about long-term cycles, seasonality, breadth of the market, We go into the selection, we look at the top-down approach where we look at the sectors, we look at the industry groups within those sectors, and then we go to the stocks level. And it's a fascinating hour and a half to be with Bruce and just to go through the whole market. Also, we looked at some of your charts that you submit, or the symbols that you submit during the class. It's important to us, to understand what you're looking at, and we come up with a lot of ideas from our students. So you are welcome to attend. You're welcome to sign up, and hopefully you become a part of our community through this class as well. Next questions. What are the major goals while using the Wyckoff method? Well, one of them is just to make correct observations. One of the things that I've noticed, after teaching thousands of students, is that sometimes we need to improve our observation skills. There are a lot of data points on the chart. If you take just one bar, there is a direction of the bar. There is a close, open, high, low, the amount of the tail, the distance of the close relative to the spread, the same for the open, then the result of the bar from the previous close within the structure, any type of analog. So imagine now it's just for one bar, but if you have, let's say, during the intraday session, 150 bars on a 3-minute or so, you're going to have a lot of data points that you need to observe correctly. Usually our minds are being attracted to a specific event, maybe like a volume signature spike, or maybe some spread that has a big tail, some bar that is unusual, or maybe this is the last bar where students are spending a lot of their attention to. I'm going to change the way how you observe the chart, and therefore I'm going to change the way how you observe the behaviors of market participants. The second thing that we're going to learn is how to make deductions out of those observations. Unfortunately, again, it requires time to produce the correct sequence of logic that comes from reading the chart. And this is the primary thrust for us, with our work with students, whether it's this class or any other classes. When you look at the chart and you observe, what do you deduce from that chart? And obviously, our main goal is just to trade alongside the smart money or institutional money that are on the correct side of the price cycle. Where do you start your Wyckoff analysis? So a pretty common question as well. Our analysis on a very high level is based on the price cycle model. We understand the behaviors of market participants. We understand how the price structure changes, whether it's accumulation distribution, how does the price go into those areas, starting with the change of behavior and then going into a change of character. We spend a lot of time on the trend analysis. We spend a lot of time on the volume and spread analysis and swing analysis. This is our bread and butter. If you want to learn something about trading, you could just literally take that, and to a certain degree, you could be, highly efficient and profitable. Sequential bias analysis. This is something that we've developed ourselves in the company in WTC2 class. I'm going to introduce you to that if you become a part of our community and you're going to move through different classes. And obviously, comparative and relative analysis of the asset that you're trading. Other questions. Do you use Wyckoff method in your trading? Absolutely. That's the only methodology that I use. I use Wyckoff method and chart reading. Can you show your latest trades? Well, I'm going to do better than that. I'm going to show you some of my trades, and I'm going to show you some of the trades from our trainees. Not only that, as I mentioned, I'm going to show you the intraday trades, the swing trade, the long-term swing trade, and the campaign trade. So stick around because there's going to be some exercises. And here is your first exercise. This is an intraday 3-minute chart. And I want you, and we're going to slow down here. I want you to look at the chart and to start analyzing and conduct the bar by bar analysis. Now, because a lot of students right away are being a little bit lost, like where do I start? And usually, they go for the for the bar that is going to be most attractive for some reason, whether it's a volume spike, or maybe there is a gap, or maybe this is the first bar in a sequence, or maybe this is the last bar. I'm giving you a specific way of how to think about the analysis. I want you to look at the spread first. Then I want you to analyze the spread body. I want you to look at the demand and supply tails. Then I want you to correspond the volume to the price action and the result of that particular spread. So when you look at this chart, and I'm going to give you a little bit of time here, what would you do at bar number 11? Would you be a buyer or would you be a seller? And once you decide what you're going to do, could you please write down in the questions box why you're making that decision? So let's see what kind of answers we have. What do you guys think? Up or down? Yaroslav is saying, I'm a seller. All right, Yaroslav, tell us when or why. Bazi is saying seller, back-to-back significant down bars. Yaroslav is saying, because I see no effort on bar number 9. Okay. Yuri is saying, I see culmination move and I will try to find a short position. Franklin is saying, I'm a buyer because I see the increase in volume moving higher from the low, which is showing demand. Carvalho saying, I'm a seller. Arash is saying, I'm a buyer with the stop at the low of the bar, higher volume and bottom of the range. Gleb is saying, oh, I see. Okay, so I guess this is Gleb as a buyer. Okay, Larry is saying up, buy the spring, took out low of bar number 5, and with little reaction. Ayush is saying selling as supply is increasing. Gleb is saying not so big supply on bar number 11. I'm full buying. Matt is saying I'm a seller. Volume bar spikes to slow and stop the upward momentum. Scott is saying I'm a buyer. Down bar less than bar number 5. Closed within the range. Monique is saying I'm a buyer. Peter is saying I'm a buyer. 5 has large demand tail at similar level and bottom of the range. Peter is saying if I started short based on the earlier bars, then I would be covering short at bar number 11. And VJ is saying I'm a seller because the trend is down. All right, excellent. Thank you, guys. And this is exactly what I'm expecting from all of our students in the classes. That type of participation, that type of engagement, and we talk obviously even more. Sometimes I'm just unmute people and we have a conversation. And that's a very, very common thing for us to do in our classes. So let's start with bar number 1. We obviously have a gap. So this is the open for the new session. That's why the volume signature is so high. Now, what do you guys think? Does this volume represent only buying? Or does it represent only selling? Obviously, it represents both. And usually, for those of you who are intraday traders, the first bar is going to be a volume spike. And then for the rest of the session, as the common volume signature, we're going to see the decrease in volume. And then occasionally, in the middle of the session or into the end of the session, we might see some abnormal volume signature that would exceed the opening bar, which is an extremely valuable information for us as intraday traders. All right, so on the opening bar, who is winning? Well, we kind of have it a little bit balanced, but at the same time, the aggression is to the upside. It immediately is being stopped by the selling that we see in the selling tail, supply tail, and also the extension of the bar itself. This line right here is our 2 days high. So we are exceeding it, but the extension above it is somewhat limited. So we're already seeing that the selling pressure is present. Now, if selling has increased at this point, even though the bar is showing up and is showing, up after the gap and over the level, again, with somewhat limited extension, what we want to do is we want to understand what is the follow through after supply is coming in. And what is the follow through on bar number 2 after supply comes in? Look at the volume signature. The volume signature drops almost ×2, and yet the price freely moves down easily. So we could say that there is some ease of movement with which the price moves to the downside. Look also at the spread body, we just call it body, right? So look at this body and look at the body of the previous bar. What is larger? What moves easier? We see that from 1 to 2, the move to the downside is somewhat easier, but there is no commitment below the low. So therefore, even though the price moves easier to the downside, we are not expecting a very aggressive move to the downside at this point. Bar number 3, an attempt to go up, and look how we are increasing the spacing between the highs of the bars ever marginally, but still this is a really interesting indication that the price now only capable of coming to the close or the open of the previous 2 bars. And into its own close, this is the lowest close in this area, into the tail of both of the bars. And again, it requires even less volume to move the price like this. So selling is still there, but it's not very dominant. So our expectation at this point that we're gonna move to the downside, but we don't expect a big move yet. We're gonna come back to this bar number 2, and the question here is this a point of entry for us? And I'm gonna argue that this could be a point of entry, but a more efficient point of entry could be down the line. Bar number 4, what do we see here? Volume signature is increasing. We see the demand tail, but only after it makes a lower low. So this is an attempt of the buyers to come in and to absorb the supply that has come. What is the result of it? Again, we see that the spacing between the bars is increasing, the spread is compressing, and whatever the follow through to the incoming demand we have is actually still in bar number 5 to the downside, with the lowest close, with the lowest low, and this extension of the spread. So if we were to look at spread number 2, spread number 5, which are impulse type of spreads, those are in attempts to break the structure, to break some kind of low. We see that compared to the up bars that are trying to move up, they are way more attractive, right? In terms of the body itself and in terms of the spread. We could also compare bar number 5 and bar number 2 because the spread is the same. And yet, look at the body here. The body is diminishing, and also we see that the demand tail is increasing from 2 to 5. That is suggestion that at bar number 5 we have a hidden demand. This is the highest volume signature after the opening bar, and this is a suggestion for the rally. So we have to wait and see what kind of rally we're going to produce. And we are producing one of the best, if not the best, up bar. We definitely still see some increase in the volume signature for the demand from up bar to another bar. If we compare 4 and 6, now our expectation is that indeed we're going to rally. But look at the commitment of the close on bar number 6. We are not committing a bar above the high of bar number 5. So even though we are expecting a rally, it suggests limited rally. So where to? Well, most likely into the open, into the target of the bars that were before that. As we approach this level, immediately supply is coming in, and even though supply might be diminishing just in general, but the effect of it is pretty significant. We are negating a lot of the body of the previous bar, a lot of the spread. So there is a retracement of almost 80% of the previous bar. What would do that? Well, selling. And how does it do this? Immediately and somewhat aggressively. Yet there is no commitment below bar number 6. So we're probably expecting some kind of exhaustion in the next type of move. Exhaustion could be identified through the volume signature, through the diminution spread itself. And in the next two bars, we're seeing exactly that. Also, look at how demand is increasing on bar number 9 relative to bar number 8 and relative to bar number 6. And that is happening where? In which area? Well, where we tried to go before. So as the price goes here, supply is increasing. As the price comes to bar number 9, supply is increasing. And with that, our expectation is that we're going to start reacting again. How do we react? Well, bar number 10 is showing us what? Diminishing volume signature, diminishing selling, and yet this is one of the best bars. This is the first bar to the downside that actually does make a commitment below the previous bar. None of the previous bars, down bars that is, have done so. So this is our potential point of entry to the downside, as we're assessing that selling is still dominant here since the opening, and buying has been exhausted. And bar number 11 is a confirmation of that. The follow through to the supply coming in is pretty aggressive. This is the most aggressive bar to the downside. This is the lowest close. This is the lowest low. And with that, it acts as a confirmation bar and also another point of entry. So let's look what has happened after that. Here is the trade for that day. I was trading NVIDIA. This is a 3-minute chart, and this is example of our intraday trade from our training program. You could see different levels that I had. This is a 2-day high. These two lines right here. This is a yesterday's high. This is intermediate points of support. Yesterday's low and 2 days low right here. So as the price starts, as I'm entering position on this bar, as the price starts to move, I'm noticing that the spread is diminishing from 1 to 2 to 3, and volume is increasing. What does it mean? It means that demand is there. But the biggest impulse so far is to the downside. So our expectation on the emergence of the demand after the aggression of the supply is that we're going to have some kind of rally. We have to take the chance and see what kind of test we could have. So this whole area right here to us is the test. Test in action of what? Test in action of the previous impulse to the downside. So as we go through that, the key, and this is what we work a lot in our training program, and I'll talk about that a lot in the next couple of slides, is not to be caught up in what we call those candy bars, right? So they look so attractive, all of those up bars. But there are two things behind them that we just don't see. What is it? Well, we're seeing diminishing volume signature. So in general, that would tell us that demand is going down. Supply is going down too. But what is the dominant force? Most definitely supply. And what is the dominant result? Most definitely to the downside, expansion of the downward result. So with that, as we can't commit behind the two most important bars on the way down, we would be staying in the position. And if anything, we would be looking for the points of entry or an add-ons, which I did on this bar right here as it starts commit to the downside. We could have had other opportunities as well. I really like this bar right here that shows a complete exhaustion of the demand behind the lowest volume signature for this session at that point of time. This bar is also very interesting as well. You could go for the significant bars as well, like I did here, or maybe you're putting some stop sell order here and you're pulled in on this bar. There are quite a few variations on the point of entries and add-ons right here. And then as we go down, we're staying in this position until we see some kind of climactic action or deterioration of selling. In this case, this bar right here produced enough limited result to the downside for me to produce the first trim. This is also in the area of the target, so I'm pretty happy that I'm trimming there. Taking the profit when you trade is great. There is a great saying that amateurs want to be right, professionals want to make money. And this is what I want to do. I want to make money. Being right is not necessarily the correct behavior in trading. And then the full exit is on the climactic bar that is extending the spread. And look at the volume. This is the most abnormal volume since the open. So this is a significant demand that is hidden that comes into the market. And my expectation here was that we're going to have a rally. And we're going to have the rally that's going to exceed anything that we've seen for today's session in terms of the rallies. And indeed, this is what happens. So I think this was a really good exit. Maybe the trim could be a little bit better. And then off we go for the rest of the session. I was just not available for the rest of the session. But there's a kind of like a typical trade that we are expecting from our trainees in our intraday training program. For those of you who are already thinking like, oh, I want to go and just do exactly that. I want to be a trainee in your program. How do I do this? Well, you start here. You start with WTC1. You go to WTC2 next. And then after that, you graduate and you apply for the training program that we've developed since last October. And you start very intense training as to how to read the chart, how to trade correctly, with a lot of the feedback from our coaches. All right, let's go to the next subject and next questions. Does Wyckoff method work in the Forex market? Absolutely. And this is just a very common question that we receive from Forex traders. You could use the price action because the volume is always under the question, and you could use structural analysis, but you could also use comparative analysis as well. And by the way, I would say that you could use the volume, even though you might think that, as a Forex trader, that the volume is not correct there. But the volume signature, the volume profile is going to be very similar to the correct volume. So with that, I would encourage you to still either use volume or use the spread for volume. And that will give you a really good indication of how to analyze the Forex market. Could you use Wyckoff method for the intraday trading? Absolutely. And I just demonstrated to you exactly that point. All right, so let's talk about training that we have. We've been going to our training as a product for a long time. The company has been in existence for 11 years, and our first concentration and focus was on the knowledge. So we've developed the market beliefs, the price cycle knowledge, the structural knowledge, the price volume knowledge, selection and tactics. Then we recognize that knowledge is not enough. Knowledge is not the skill that you need to have. I meet quite a lot of just brilliant, smart, knowledgeable students of Wyckoff methodology, and yet their skill is underdeveloped. So what we do with our students that graduate from WTC one course is we suggest that they continue on their path, not only to know the methodology, but to actually develop the skill of pattern recognition, of the bias analysis, of the execution. And we do that through a lot of simulations. I mean, literally, our coaches will be sitting down with you, either in the group environment or in the private sessions, and we're going to go through the chart bar by bar, swing by swing. We're going to be asking you questions. We're going to be seeing how your trading is going to be developing from the simulations to actual trading, and how your mistakes could be systematized. We usually try to find what we call a commonality of the mistakes, and we will be giving you the feedback as to how to correct that. But even that was not enough. We realized that we do have to have a specific process behind our trading that would involve planning of the trade, planning of the trading process, a look at the trading variance, meaning how far away your results from the actual trading plan execution. The process variance as something that you need to do each day, each week, and you don't do this. Journal and feedback loop, and again, a lot of simulations. And then we realized that even that is not enough. and we need to look into the mindset, because when the skill level increases for our traders, our students, the mindset is the final frontier of where we as traders limit ourselves, and that creates all of those mistakes that could be the mistakes just in general, technical mistakes or tactical mistakes, but also some sabotaging behaviors that lead to the mistakes of undersizing profitable positions or not staying in them long enough or overstaying there, and so on and so forth. So we started to look a lot into the self-awareness, into the feedback loop, and to behavioral change. I could talk a lot about this because this is primarily where, myself working on my trading, and obviously I still work a lot on the technicals, the process and the skills. But at some point, your total concentration is going to be on the mindset. So all of that, when you combine all of these 4 areas, you need to practice it. So how do you practice it in such way that your progress becomes, expedited? The only way to do that is through intense training. So we've created last October for both intraday and swing traders our training modules. It's a very disciplinarian environment. I like the discipline of the mind. So therefore, when people come to us, there are certain things that we ask people to do, and they have to follow it. And if you don't follow it, it just we are not on the same page. So we have to be on the same page in order for us to give you what we have and to create the trader that you want to be. We constantly review and give feedback to our trainees. We work on the behavioral changes a lot. We go on the process a lot, and the group dynamics help tremendously when you go through such intense training. What I've noticed from training is that people who come to training, they increase their technical skill, I would say like astronomically. And the level of self-awareness increases astronomically as well. And this is our goal. It's to increase their technical level and then to increase their level of the self-awareness. That's what helps them to overcome a lot of the common mistakes that they've been making for years and years. Now, I also noticed that people who stop training and go away from the system that we've developed start having marginal results. So to me, what it tells is that you have to habituate in the training system for a while. You can't really take, substantial breaks. You always have to be in the environment of the focus where your mind is not allowed to produce different behaviors. So just kind of like a side note on this. So if you're interested in training as a product, please remember that, the first initial prerequisite is this class, WTC1. Then WTC2. There are some other prerequisites, intraday special, swing special that I've conducted, this year, and also the trust the process special. Once you have all of the prerequisites, you are welcome to conduct the interview with our chief trainer, Tony, and myself. And through that interview, we'll, you will introduce yourself as a trader. We'll figure out who you are, whether it's psychological profile or just technical profile. And you're welcome to join us. We have both swing and intraday training. All right, let's go to the next chart. And here I want you to conduct Wyckoff analysis. I want you to think about the sequence of the analysis. One of the problems that students or traders have using the Wyckoff analysis or any other methodology is the sequence of the analysis. Usually the concentration is always like on something specific. Oh, I see this bar. This is weakness. So therefore, I'm expecting everything to go down. Or maybe it's a concentration on the last bar, or it's down. So therefore, it's going to go down. We don't do that. We want to be logical, we want to be sequential, and we want to understand how the price and volume tells the story, the Wyckoff story of institutional participation. So the first thing that I want you to do, and please start writing again, what do you see as a global structure here? We also can call it a background. Second thing that I want you to write down, define the global swings. Well, I kind of defined the swings for you here, just for the simplicity of it. I want you to look at the swings from 1 to 9. Look at the downswings and make your analysis of what's happening with selling. Then look at the upswings, make your deductions about what the buyers are doing, and then define the dominant force or bias. So let's do exactly that. What do you guys see here for the global structure? What is the background of this chart? It's an uptrend. Vijay is saying, okay, great. And what happens after the uptrend? Because this is the global structure as well. A trading range. Exactly. So this is a very simplistic way of looking at the chart when you look at the global structure and the background. The background is to the upside. The current environment is the trading range. Now let's go to question number 2. Let's look at the global swings. Well, actually 2 to 4. And let's start with the downswings. So we're looking at swing number 1, 2, 5, 7, and 9. What do you guys see happening from, let's say this is a complex structure right here for swing number 1. So let's just discuss swing number 1 first. What do you see in the downswing number 1? What is happening with selling? Descending range, Arash is saying, okay, I'm seeing kind of like the linear regression channel like that. Selling range is reducing, Vijay is saying. Selling starts strong, but is absorbed by Damien. Yaroslav is saying selling is diminishing. Roberto is saying, I see the downswings get smaller and smaller over time. Charlie, okay. Gleb is saying diminishing volume. Larry is saying volume selling bars. What was the first word? Okay, but little follow through down. Okay. Yeah, we could look at the first swing to the downside. It's complex in structure, right? So it has 1, 2, and 3 as sub swings. Nothing is being reversed on the gap bar. So we see the aggression of selling. This is the highest volume signature. So much selling is coming in. And now we would be looking for the upswings. How does the price behave in the gap? So that's going to be an important reference point for us into the future. And we're seeing how selling starts to diminish from this level to this level right here, to the exhaustion of this move. Look at how much of the selling decrease we have. That's substantial. So, and that tells us that there is some kind of expectation for the rally that we have at point number 1. All right, so if we were to take the whole swing at 1 and compare it to swing number 3, what would you guys say is happening with selling? Is it increasing or is it decreasing? Is selling increasing or decreasing? Larry is saying selling is coming down. Yuri is saying selling is decreasing, decreasing from Daniel Barcy. Same. Gleb is saying BJ decreasing. Everybody is saying decreasing. Yeah, absolutely. Selling is decreasing. The intensity of selling is decreasing. Now, this is a very important question as well. And what is the downward result of that decreased selling? Does it break the structure or does it stop at the support? And obviously we see that there is no continuation, there is no follow through below the previous lows of the trading range. With that, we would be saying that the downward result is decreasing as well. What does it mean? What's the deduction out of this observation? Well, that we should be expecting some kind of rally, right? So we were expecting a rally at point number 1 when selling has decreased significantly from the point of the gap. We're seeing at 3 that decreased selling cannot produce meaningful result, but we still have a relatively good distance that we have had in the previous swings to the downside. Now let's talk about selling on swing number 5. If we were to compare swing number 5 to swing number 3, what is happening with selling? Is it increasing or is it decreasing? What do you guys see? Decreasing. Decreasing was the high low. Decreasing was the high low. Weaker volume and decreasing selling. Decreasing, decreasing. All of you got it. Yeah, absolutely. We are decreasing selling. On right here, there might be some increase in selling right around this area right here. But look at the takeoff of this and compare it to, let's say, this or this or this. It's definitely less aggressive as the start of selling, where supply is coming in. And behind this, there is a lot of hidden demand in this small bars right here. The distance of the swing is decreasing as well, producing now more of the spacing, a higher low, and this is a very favorable thing for us. So we would be saying that the downward result is decreasing even more than before, which definitely is more bullish for us. And there is an expectation that the rally is going to happen because of that. All right, now let's compare 5 and 7. Is selling decreasing even more? And as a result, even better? We want to see that type of improvement if we were to decipher this trading range as an reaccumulation trading range. That's what we want to see with selling. During the trading range, after the uptrend, we want to see the decrease in selling, and we want to see the decrease of downward result, which would suggest that selling has been exhausted and the price is ready to move up. And all of you are saying, yes, indeed, selling has decreased substantially. And the downward result has decreased even more. So we have the consecutive instances where selling not just decreasing, but the decrease in selling decreasing result itself. Very favorable for the up move. And then let's look at swing number 9. We see the increase in volume signature. We see the increase in effort to push the price down. Yet, this is the highest low, and look where the close is. It's actually in the area of the gap, and it is the highest close on any of the downswings that we're observing. So what kind of deduction could we make? Is this a progressive improvement from swing number 1 to 3 to 5 to 7 and to 9? Yes, absolutely. And all of you are saying it is an improvement. So therefore, we are observing hidden demand here. This is the buying at the higher level of the trading range. So with that, our expectation, just based on selling wave alone, that the bias of this trading range is going to be what, guys? What do you think? Reaccumulation or a distribution? Most definitely reaccumulation. But let's be thorough. Let's look at the upswings. And we would be thinking smaller upswings right here. We see some improvement for the swing number 2, right? Look at the volume signature, how demand is increasing and how we are extending the swing off the low where supply was exhausted. We see the decrease of the upward result in swing number 4, and we see somewhat of the decrease of the demand. What would that suggest within the structure of the trading range? Well, probably some kind of retest, some kind of testing, some kind of reaction. And then how would you compare upswing number 6 to upswing number 4? What would you say? Is demand increasing? And is the result increasing? Well, demand is most definitely increasing. A lot of you are saying that it's a stronger swing. We're overcoming the previous highs marginally by one close, but this is the highest close since the gap. So, and look at the spread, how the spread is increasing relative to swing number 4. So that confirms the improvement of not only demand, improvement from deterioration of selling and diminishing selling result. We're seeing also the improvement of the spacing for the demand as well. So, and again, this is a very encouraging side. But we definitely have something of a minus selling, and those do come at the end of the swings like this, right? Where before the swing to the downside, we're gonna have some kind of climactic action that we're gonna observe that would produce the next reaction. And that's normal. Our assessment is how much of the supply comes in. And I would say, like in all of the 5 instances here, supply is somewhat the same. It's the same behavioral signature by institutions where they're taking some of the profits at the top of the trading range. And because of that selling, the price goes into more testing. But the key here, as supply occurs at the top part of the trading range, and we could have a little bit of a slope here, is to understand what does it produce. Does it produce a higher low? And how much of the higher low does it produce? And how much supply is actually coming in? So all of that we will be studying in a lot of details. Obviously, I'm going extremely fast right now. So what would you say the dominant force is? Is it buying or is it selling? If we are in the recumulation. And as all of you are saying, most definitely buying. So this was an actual trade by one of our trainees. She produced this trade right here. She opened the position on the open of this big bar and closed it on the change of behavior bar. Now the price marginally went up after this, but the environment became a trading range and then a reaction that went considerably lower. And this is SMCI. But look at this beautiful trade from 350 into about the close at 950, 900. So that's around times 2.5 times 3. That's what we're looking for our swing traders as the best type of opportunities that we want you to develop the skill to recognize before it happens, to recognize on the bars of interest where you take the position, and ability to stay with this position. We'll talk a lot in our classes about how we actually move the stop loss. What would be that area of where we would accelerate our stop loss, or the areas where we would move, on which bar we actually have to move, and where. And look at this beautiful institutional participation right here and speculation on the way up. Obviously, behind all of AI-driven news and demand. Let's go to other questions. What expectations should you have when taking a WTC1 course? Well, you might already feel it, drinking from the fire hose. It's a very common comment from students to me, is that I give too much material and that each session is just so packed with so much information or drills or practices that it's the same as drinking from the fire hose. It's intentional because I do have a lot of information. As I've mentioned, I've been doing this for 30 years, so you can imagine how many charts did I look at, how much knowledge I've accumulated at this point. But I'm giving you the knowledge that is essential for your success. I'm not necessarily giving you extra knowledge. I'm concentrating on the knowledge that you have to acquire to be profitable and to be consistent. But it's still a lot. And that's why this is one of the reasons of why some of the traders fail, because there is not enough conceptual understanding. There is not enough details into the how do we read the chart, what do we look at, how do we systematize our analysis, where is the logic of the deduction, what does it bring us to. So a lot of information produces confusion. You have to stay with that confusion and be emotionally okay going through a lot of the ups and downs, a lot of the failures. And believe me, I make mistakes, even in today's trading. There were some mistakes that I made, which I've discussed already, in our post-trade analysis session. And I've already received the feedback on that. And just as a side note, I love trading and I love to be a part of our trading community, and I love to be the student as well. I think that the more humble you are in terms of your knowledge and the skills, the more you have the capacity to receive the knowledge and build that knowledge up. So if you are like me, then come to us, because we would be of the same mindset. And our community is same-minded people trying to achieve the same results. And we support each other, whether it's me supporting you, our trainers supporting you, or your peers supporting you. It's very lonely out there if you do it by yourself. But if we do it together, we call this a collective hive, a collective mind. We all work together on the same problems. So the second thing, the expectation that you're going to work, that it's not just going to be, I'm going to attend the class. I mean, obviously you can do that. You could just come for the knowledge. And I understand sometimes the circumstances of life, put a lot of pressure on us. And this is where, we have families, we have 9-to-5 jobs, we have other things that could distract us. So you choose the degree of involvement that you want. You want to be just a student, an observer, a listener, that's totally fine. You want to build up the skill, then I'm going to ask you to do the homeworks, do the drills, do the action sequences, bias games, and so on and so forth. You want to go into something more intense where in a year time or 2 years time, you start producing meaningful results. So that's going to be your training. And then, the accountability there is way, way higher. You will have to do the work. Thirdly, you will drastically change the way that you analyze and see the chart. This just happens to not necessarily all of the students, but to the majority of the trainees and a lot of our students. And a lot of our students report to us that, and just again, I'm trying to be extremely humble here, so I'm just quoting our students, that this was by far the best investment into their trading education. Just understanding how the market structure unfolds, understanding the relationship and interaction between price and volume, and also understanding yourself. How do you trade? What do you need? What kind of process do you need to create for yourself? Where is your personal edge for your trading? So I'm just bringing to your attention what other students are saying to us. Can I expect an immediate improvement in my trading after completing the WTC1 course? Yes, if you are familiar with some of the concepts that Wyckoff methodology has, or technical analysis, and we could build on that very quickly if you already have some knowledge behind you. If you're new to trading in general or to the Wyckoff methodology, then absolutely not right away. You will have to spend some time understanding how to read the chart, what concepts we're discussing, and how to see them on the chart. And I already mentioned this. It usually takes a year and a half to complete the whole process of acquiring the knowledge, developing the skill, establishing the trading process, working on the mindset. And one of the things here that I'm not mentioning here is training, right? So this could take between 1 to 2 years as well. but you could get here faster. I mean, like if you do have an opportunity to make it a full-time job, if you have those, like savings and you can go through a year or two and you could just concentrate on 8 hours a day, believe me, we will push you to such limits that you have not even think about for yourself. And in a year time, with consistency, if you're not interrupting, the process, if you're very consistent in the way how you approach this, your results will start showing themselves literally within months. And I have factual evidence of that from the P&L of so many trainees that we have in trading and students as well. I constantly hear stories from our students that say, well, I made this trade, based on the knowledge that you have given us or based on the drills that we've done. And I, renovated the kitchen. I established the college fund for my kids. I've, put the money into some kind of alumni program for my alma mater or something like that. So it's really humbling to hear those type of feedbacks from our students and trainees, and I'm just really grateful of how we could help our students. Let's go to the next chart. So now we are looking at the long swing trade, right? So it's not just the swing trade that originates somewhere at the bottom of the swing and then we get out. We're actually staying in this position for quite some time. This was my trade back in 22, 23. I have not been actively trading on this time frame in 23 and 24. I've just been concentrating more on shorter term swings and also on the intraday. But this is probably one of those examples where you could see, how I would be behaving in the market. The trim here that came was based on the increase of the volume signature. The price went, higher after that. I'm definitely looking at the stopping action, multiple trading ranges that show not just the emergence of the demand that is being accumulated by institutions, but also shows a sign of strength as buying increases and institutions are pushing the price into the gap area. I'm seeing a favorable test. There were most definitely earlier points of entry, but this is when I saw this position. This was kind of an ideal place, those two bars for the point of entry. I think I'm picking up maybe the third best opportunity here after a second sign of strength at the backup action. I'm just staying with the trend and getting out at the emergence of the supply. So there was a trading range right here, and then the price went up. All right, next question that is being asked very often. Do Wyckoff schematics predict the future path of price? My answer is no. There is too much emphasis on the schematics. And, when I created this schematic right here, and Hank was my editor for those schematics, I think that was back like in early 2000s or so. And I posted them on Stock Charts, and Stock Charts has been such a great partner for us for years and years. So we're extremely grateful for that connection. People take this and they literally apply it to a price structure. And in a lot of cases, it does work. But there are so many variations on how the price could bottom. There are so many variations on how the price could top and what kind of price structures that would create. And this is what we study in our classes. I'm just going to give you not just one, not just two, but multiple schematics as to how the price might move. And then we'll study all of the events. The idea behind accumulation and distribution is the idea of the reversal, and the idea that there are certain things that need to happen before the price starts to move in the opposite direction. So what are those things? What are those events? Well, first of all, how do we stop aggressive selling into the accumulation trading range? Well, we need to have some kind of stop in action, which is our selling climax. There are certain characteristics of the selling climax that we know and that we want to see on the chart. We want to see also a change of behavior, which is a part of the automatic rally that tells us that not only the stop in action was successful, but also we see the sellers that are giving up partially, and also buyers are being present, and now they're pushing the price up. And then throughout the whole trading range, we go through what we call phases. It's a period of time in the trading range, which is defined by the dominance of sellers or buyers. And it gives us the clues as to what is more dominant, selling or buying. We have multiple tests in the trading ranges at the support, at the resistance, and as we develop more bullish characteristics during phases C and D, on the sign of strength, on the backup action, this is the springboard that from which we want to take a position and or start building up the position. Again, this is something that we will be discussing even in the second class next week. And well, actually, next week is a Labor Day, right, in the US. So we will not have the class, but we will, for all of you students, I'm going to tell you the substitute date for this class, or we're just going to move it, a week after. So please stay tuned for those of you who are students, and we'll deal with this within the next day or so. But we will be going in the second class into the accumulation schematic, and I will be giving you a lot of different pointers as to how to understand the concepts behind behind those schematics and the events and phases. All right, let's look at the next trade. So this is an ongoing trade for me, and you might say like, what? Really? Are you Warren Buffett? Well, I have never had a position that I've had for 20 years like Warren, but hopefully I'll get there. This is my position that I've opened in GLD. This is the ETF for gold. And back in 2019, I saw this whole structure right here as a potential accumulation. In fact, I went on record with my call and with this position. At the time, I was on one of the TV programs, internet TV, and just stating that I've just opened the position. And for that particular, well, actually, this was even here in 2018, I believe. Yeah, I was like at 112. Excuse me, I need to change this a little bit. So the call was that by the end, 2019, by the end of 2019, we're going to hit 150. That was incomprehensible at that time because the price was just, fluctuating, swinging, at the lower prices. But what are we seeing there? And thinking about the schematic that I've just shown you, and you could see how different the schematic is. Well, we're seeing an attempt to stop, still a lot of weakness behind the selling and the impulse to sell. We're seeing still lower highs in this area, which is suggestive of the lower low. We see how selling is diminishing. And now finally, we see the bars that are showing buying and that are showing more aggressive buying. Obviously, still some supply is there. So that produces all of those reactions that are still pretty aggressive. I mean, look at this bar right here. Even though it doesn't have a lot of selling signature behind it, but the way how the price goes down tells us that we're still going to test. And keep in mind that this is a monthly chart. So it's an enormous structure right there. The way how the rally has happened here has no buying that is aggressive, again, suggesting some kind of reaction. If we were to compare this reaction to this one, we see the deterioration of selling again, and that suggests that selling is at some point exhausted. We're seeing the improvement in spacing, and most definitely this acts already as the last point of support for us, where the price comes in and holds and holds and holds and rallies from those points. And the last reaction, if we were to look at the last 3 down bars before I opened that position, how different it is from the previous reactions. Well, meaningfully different, right? So significantly different. So, and with that, at the level of the selling climax, this is a really good place for us to take a position. And I'm just holding through this area right here. Why? Because I took the P&F horizontal count of this whole structure. And P&F in Wyckoff methodology is the projection of the causality. Our cause is the trading range where institutions have been accumulating their shares all of that time. So once I've projected this, there were 2 targets, above 2,000 and then above 4,000. Well, this is my IRA account, so I don't really care about the interim targets. This is my goal right here. It was my goal back in 2019, and I had a strong conviction about that. It is still my goal right now, and we are just, hit the 2,000 target at this high right here, or close to that. And then we went into what we would call a backing up action. Now, in this case, it's a complex trading range. That started with the supply that came in this area right here. But this trading range is still showing a lot of great signs of improvement. Supply is coming in. What is the next reaction? Look at the limited extension to the downside and look how much of the decrease of the supply we have in that reaction. And then compare it to the next reaction. What do you see? Spacing is improving significantly, suggesting immediate continuation and more aggressive continuation than whatever we had in this trading range. And still, I'm in this position. I do not have any intention to give up this position until my target is hit, or I could see more of the distributional formation like we have had back in 2011-12. So this is our idea of the campaign trade. And you know who's extremely brilliant with the campaign trading is Bruce Fraser, our in-house Wyckoff expert, who I have the utmost respect, for all of the years that he's been using Wyckoff methodology, for everything that Bruce brings to the table in each class. We talk with him a lot about those long-term ideas, long-term campaigns. So this is just one of the examples, and he's got plenty of such examples. So if you're a trader like this, or you just have maybe like IRA account where you just want to put the money in, you do not have an opportunity to look at what's going on the daily or even weekly basis, well, then this is the type of trade or trading that we could develop for you, and you could develop with us. All right. With that, I definitely want to point your attention to the bias game. Bias game for us is one of the tools that we've developed for our students to gain proficiency and to develop the skill of how to read the chart, how to read the trading range, how to define the bias. And it's been such an amazing journey with the bias game. We've had this for, I believe, over 5 years now. There are different variations of the bias games that we've developed, a lighter version of it, or more in depth. I have written myself over 200 bias games. Go to our website, and on our website you could find under the free resources the bias game. And as we have over 200 of those, just go through them one by one. Just even that work alone, if you do this as a deliberate practice with a lot of slowing down and thinking through what I say in the Wyckoff story as my feedback to your bias decision, you will learn so much. You could do this on our website. All of the fresh bias games can come out on our Twitter at Wyckoff Analytics. And also, if you are going to be a part of WTC2 practicum class, which is going to be conducted tomorrow on Tuesdays, you most definitely will encounter a lot of bias games in that class. This is where we usually take at least a couple of bias games and we go with students through them. And I am a student in that class. I'm a student of the bias game as well. So I ask our students to create the chart for us so that I would not know the ultimate answer. And I want to go through the same process because I'm learning myself. And this is my whole attitude toward our classes and studies and the way how I want students to conduct themselves. Be like me, be the student, always learn something each day, in each chart, in each class. Do not be light in the way how you look at the chart. Be thoughtful about what you do. All right, so for those of you who are already the students in this class, this is your homework for next week. And we'll talk about the Labor Day, so don't worry about this. We'll figure out, what are going to be the dates there. I think that we're just going to, have like a little bit of the postponement of this class into the next week, but I'll find the time to meet with you. But your mandatory assignment for next week is to read James Forte's Anatomy of a Trade range article. It's only 12 pages, but it's 12 pages with a lot of information. So read slowly and make notes. Ask questions. And we're going to discuss this in the next class. Also, as I said, we're going to dive into the material. We're going to start with the price cycle, with the behavioral market analysis. We're going to look at the accumulations and reaccumulations. We're going to talk about different institutional participation, and we're going to start working. And the homework in the second class is going to be actually work with charts. This is what I want you to do in this class. So lots of work ahead. With that, this is it for today's sessions. Let's go through some of the questions. And I probably have to, I'm going to start from the backwards. Bazi is asking, do you use options to trade campaign trades? So I love trading options, but I'm staying in this trade for over 5 years, so there are no options like that. The long-term options are usually from 9 months to 2 years. So with that, this is not the vehicle for me to trade, to do a trade like this. With that, this is all cash. But where I do use options a lot is with swing trading like this. So this would be a long-term option for me. And with the swing trade like this, this would be a short-term option for me. A short-term option, I usually go the lowest, expiration is about 3 months to about 9 months. And I know I'm more conservative. I do not usually like expirations that are extremely short unless I'm intraday trading options. Then I could go to the weekly options. But if I'm swing trading this type of trade, and I know that the duration of my trade here could extend to 1 or 2 months, no way I'm going to be buying options that expire in 1 or 2 months. I'm going to be thinking at least at the minimum of 3 to 6 months. And that's going to be my expiration. All right, next question from James. How soon do you start exposing your students to the PNF charts? Will it be comprehensive? James, really good question. So my advice usually get the basics first. Understand the methodology, understand the schematics, understand the behavioral market analysis, understand the price cycle, understand how to read the chart. And then once you know all of that, then go and go through the point and figure special as a course that we've created. It has so much material, around 8 hours of material on the PNF. And again, Bruce Fraser is the top man in the world on the horizontal PNF count. I have not met anybody who is better than him. He has so many nuances and details about the PNF. So him and I, we've been teaching PNF for years. We have created multiple specials on that. But lately, we've combined all of the specials into one complete, comprehensive course on the PNF that goes from the basics to the advanced concepts, from the construction of the chart to actually concepts of like the timing based on the PNF. All right, so we were talking about the PNF, and there's a question, what is the PNF? PNF, Yuri, is point and figure horizontal counting. So based on the point and figure charting, we could define, we could measure the causality of the trading range and institutional buying or selling in that trading range and project this as an effect on the price movement. So for instance, we would take the counts, let's say, from in this area right here, or we could extend the counts even more. And then we could project of how much of the price extension into the target. Okay, let's go to this chart slide right here. Okay, are there any similarities on concepts between Wyckoff and Elliott wave methodology from Sam? Wow, what a great question. Well, first of all, I did study Elliott wave back in like mid of 1990s when I started my career. Really loved it, but it just was not me. It was just discussing the structure, which is very similar to the Wyckoff methodology because we always talk about the price structure itself. What I felt was missing for me personally from Elliott Wave, and I have so many great friends and colleagues in Elliott Wave. For instance, one of them is Jeff Kennedy, who I just adore the way how he sees the market structure and how he trades it. So would highly recommend you checking out his work and getting his book, which is extremely practical because he's a trader. And what we just recently found, like literally this month in training, is we found the structure that Rolf Elliott was looking at. Literally, I think that we are seeing now the way how he thought about the structure of the market and how he came up with this 1, 2, and 3 waves or 5 waves in the structure. But obviously, our understanding of the structure is not just based on the price movement alone. We also put so much emphasis into the character. So that's our contribution in the addition to an idea of the price structure development. Beyond that, unfortunately, I can't say without revealing some proprietary information. So, but it's just exciting, just to see what Ralph Elliott or Richard D. Wyckoff or someone else sold like 100 years ago. So it's just amazing. All right, next question. This comes from Gleb. Do I understand correctly? There are two sides to the market, the composite operator and ordinary individual traders who trade different methodologies. Gleb, I think this is a little bit simplistic way of thinking about this. I have spent 3 years working as a hedge fund manager and just seeing the way of how institutions work day to day, how they create their portfolios. And as a co-manager of the hedge fund, I was responsible for selecting the names, putting the money into it, putting a lot of money into it, and then making that trade. So the way how you create a meaningful position as an institutional position is that it takes time. And with that, there are certain behaviors that institutions exhibit. They can't really go into the position fully right away, and they cannot get out of the position fully right away. But also so and that creates the structure. They create the structure of the trading range, creates the structure of the trends, and so on and so forth. But also what I figured out also working and mentoring a lot of registered investment advisors or hedge fund managers or any type of like, insurance pension type of managers that manage the money is that not all of them and not all of the institutions are correct, and they make mistakes. Even Warren Buffett makes mistakes. I mean, think about his IBM trade in 2017. And he has quite a lot of those. And, he is so up forward about his mistakes, which I absolutely love. And I absolutely respect him for recognizing that he made a mistake. So him being in those mistaken trades on the wrong side of the price cycle makes him what? Is he a composite operator just because he has a size but he is incorrect? No, it makes him, weak hands on that particular trade. So I can't really put public just into the category of weak hands. Plus, a lot of us and a lot of you have great trades. So if you're on the correct side of the price cycle, I always say that you're the strong hand. You're contributing to the advancement of the price in the correct direction. So in my view, there are strong hands and weak hands, and there are strong hands that are institutional and retail hands, and there are weak hands that are both institutional and public. So that's how I view this. And again, this understanding came through years and years of working with different people, of working with institutions, working with retail traders. So I would most definitely not go back into 100 years ago and based the heuristics just on what was given to us by the original course. Do you use fixed range volume profile or volume moving average from Yuri? I'm using just a simple volume profile. Sometimes, we do look at the average volume, but as you see from all of my charts, I do not have indicators. Why? Have I used them before? Yeah, absolutely. Do I use some of them like relative strength? Absolutely, I will use them. Maybe some other indicators of interest I could use from time to time, but my read is always the primary data points, which is what? Price, volume, time, sentiment. Sentiment I could extract from the price movement, and then the three main one, price, time, and volume, are always gonna remain constant for me on the chart, something that I wanna see. Okay, next one. Do you know anyone using the modern smart money methodology? Well, I mean, Wyckoff method is based on the idea that there is smart money. To me, smart money is not necessarily someone who is smarter than you. To me, smart money is participants who are on the correct side of the price cycle. So that's how I think about that. All right, I think that there were some other questions during the session, so let me go up and see. How soon do you start exposing? Oh, so this is the PNF chart, okay. Can you comment if market environment changes on what trades you pursue, intraday versus swing, short-term swing versus long-term swing? From Bozi. Yeah, really great question, because you need to understand where we are in the structure and what kind of environment we are in. Is this a good market environment for the intraday trading or swing trading or long-term trading? Because volatility changes. So for instance, most recently, in July, in August, we had a decline, and then we had a very rapid rally where the spread was increasing. So what timeframes are most beneficial for us to trade in that type of market environment? There are two, and as spread increases, it's definitely intraday. So our intraday traders had really great month. And then short-term swing traders, because you have short-term swings up and down. So with that, you need to understand the environment, and you need to understand who you are. Sometimes you understand the environment, but your repertoire of trades is very limited. You might be only an intraday trader, or you might be only a swing trader. To develop yourself as kind of like a full-time trader, I always say that you need to recognize opportunities in front of you. It's not necessarily that you're chasing or a long trade or a short trade, or a trade in NVIDIA or a trade in the S&P. What you're really chasing is the understanding of the opportunities that the market present itself to us, and then picking up the best opportunities that are available right there. So such a great question. All right, let me see if I have anything above. Okay, any other questions that came earlier? And I see some questions are still coming in. So I'll stay until we have answered, a lot of questions. Okay, so it's the same question from Gleb. Okay, so let's go to a couple of other questions. Will we have lessons about psychology, control of emotions? Comes from Yuri. Yes, I actually talk a lot about psychology, but I talk a lot about psychology in training. We do have some specials on psychology and the mindset. You could check those out on our website in the on-demand section. Training is kind of populated with psychology. You just can't get to a very, very high level of execution, very high efficiency level without understanding who you are. Because trading is just a self-mirror. You reflect off it, right? So you have a loss. You ask question, why did I do that? Even though I know how to trade, and I saw this point of entry, and I saw this point of exit, I saw this add-on, but something stopped me. Something put a limit on my behaviors. So those conversations are constant in trading. What is the target on the Bitcoin from VJ? Which target, VJ? Right? So what are we talking about? To me, the question about the target is absolutely secondary, if not, third order of a question. To me, most importantly, the main question is, what is the bias? So what do you think, Vijay, is the bias with Bitcoin? Because I still don't see the strong up move there, and I see some consolidation. So how could we have any targets in the consolidation? We need to resolve the bias question first, and then answer the question on the target next. All right. I see no other questions. Okay, one more. What is the pathway to your training program? Okay, yes, WTC1, WTC2. You also have to take the Trust the Process special, depending on who you are as a trader, intraday or swing, intraday special or swing special, and then conduct an interview with our chief trainer, Tony, and myself. And then we could talk about the admission to the training program. All right, anything else? Was a pretty fun class. I'm looking forward to working with all of you guys. Do you guys teach any Wyckoff course 2 material focus on the intraday using tape reading charts from Damien? Yes, absolutely. We do. I bring some examples, and this semester is going to be very exciting in WTC2. You will see this tomorrow because one of our trainees on TAL, as I mentioned, his name is going to join me, and he's very prolific reading the chart. So we're going to have so much fun, and we're going to go into such depth of bar by bar, swing by swing, price structure. Join us. Seriously, if you want to improve your tape reading, chart reading skills, absolutely. Do we get to join the broker? No, you guys, whatever broker you use, whatever chart services you use, those are good for us. We do have some recommendation for chart services. I mean, I could tell you what brokers I use. I'm using TD Ameritrade, and I'm using AMP. I also have the Interactive Brokers account. So for different purposes, right? So like my RA account is in one place. I intraday trade in another because of the margin that they have, and my swing trading, options trading, is with another broker. So it just depends. Do you find difficulty sometimes about analyzing the trading range, whether it's a redistribution or a reaccumulation or distribution from Ayush? Absolutely. Yeah. I mean, with time, you get better. Absolutely. But, I am not afraid to say that I do make mistakes, and I fully expect myself to make mistakes. It's just impossible to be always correct. I mean, sometimes you go on some crazy periods of, like our trainees would go like 40 days out of 41 being profitable. Or like other examples, like 20 days out of 23, 17 out of 25, or like 30 out of, let's say, like 35. I had periods of draw ups where like my largest draw up in terms of the wins was 22 successful intraday trades in a row. So that was something that I still cannot replicate, but sometimes was those periods come, you're in a good environment and you're in a good psychological state, so you just execute really well. So with that, it just depends. It just really depends. How do I get access to the WTC2 class, intro class? Please go to our website or Twitter, find the link to sign up for tomorrow's class, attend it. If you can't attend, we'll send you the link with the whole video. Where do I sign up for tomorrow's complimentary class? So same question, yeah, go to our website, go to Twitter. James, are you basing your long-term campaigns based on the size of the course that has been built? Yes. Or there are other factors like theme stocks or stock stories? So we pay less to the idea of the theme stocks, although how could you not say that NVIDIA is not a theme stock, AI driven? How could you say that SMCI is not an AI driven stock? Or Tesla is not thematical, driving all of the auto industry group, as one. So yeah, there are some thematical stocks that we follow because of the ideas. Like for instance, together with Bruce and WMD, we follow and we've developed the whole idea that we're going to follow for the next probably 5-6 years. We talk a lot about stocks. We ask our students to identify those, and we constantly look at them as an idea of something that is in a greater diffusion innovation cycle, something similar to the diffusion of innovation cycle that we had during the 1990s with the internet. It's very similar how everything develops. And Bruce and I, we've identified even some of the phases of that development and how they look on the chart. So you're welcome to sign up for WMD, and from time to time we will be talking about those stocks in particular. All right. Okay, no more questions that I see. Really great class, really good start. I like everything that we went through today. I think I'm gonna stop at this point. If you have any questions beyond of what I've addressed, please email us. If you have any administrative questions, please ask Nancy. Email us at Wyckoff Associates or info@wyckoffanalytics.com. Looking forward to being with you this semester. For all of the students that already signed up or who's going to sign up, looking forward to working with you. And until next week, thank you guys so much. And until then, bye-bye.